What is happening, crypto fam? Welcome back to Bitcoin Bulletin, your premier source for the pulse of the digital asset world. The market is absolutely electric right now, with news dropping faster than you can say, hodl. We've got seismic shifts in institutional flows, major asset rotations, and even sovereign nations making bold moves in the crypto space. You do not want to miss what's unfolding. Get ready, because the game is changing and we're breaking it all down for you. First up, we're diving deep into how regulatory clarity and the groundbreaking adoption of Ethereum ETFs are potentially unlocking Bitcoin's own institutional future. Is this the catalyst we've been waiting for? Then, hold on to your hats because the narrative flips. We're seeing Ethereum ETF surge while Bitcoin, yes, Bitcoin, is losing some of that institutional favor it commanded just weeks ago. What's behind this dramatic pivot? We've got the inside scoop. After that, the ripple effect continues as Bitcoin itself is nearing a 7-week low, with traders visibly shifting their focus and their capital towards Ether. We'll explore the indicators and the sentiment driving this significant rotation. And finally, we're heading to the sands of time as we uncover a fascinating and perhaps cautionary tale from the UAE about their sovereign crypto strategy. What can we learn from their approach? Stick around, because this is the information you need to stay ahead of the curve. Let's get into it. Don't forget to smash that like button, subscribe if you haven't already, and ring that notification bell so you never miss an update. Regulatory clarity and institutional adoption, unlocking Bitcoin's potential. Could clear regulations be the key to unlocking Bitcoin's institutional future? The digital asset landscape is in constant flux, and recent developments suggest a significant shift may be underway, driven by the intricate relationship between regulatory clarity and the burgeoning world of exchange-traded funds, ETFs. Specifically, the successful adoption and performance of Ethereum ETFs are being closely watched for their potential implications on Bitcoin's own institutional adoption. This evolving narrative centers on how the success and structure of one major cryptocurrency's ETF could pave the way for, or even influence, the institutional embrace of another. The core idea is that the regulatory frameworks and investor appetite demonstrated through Ethereum ETFs could serve as a blueprint or a catalyst for similar advancements for Bitcoin. The conversation around regulatory clarity has always been paramount for institutional investors. The uncertainty surrounding digital assets has historically been a major barrier to entry for large-scale capital. However, the recent approvals and subsequent inflows into Ethereum ETFs signal a growing comfort level from both regulators and institutions. As these ETFs gain traction, they provide real-world data on how these products can be managed, traded, and regulated within existing financial systems. This success can build confidence and potentially streamline the approval process for Bitcoin-related products, or even lead to more sophisticated investment vehicles that incorporate Bitcoin. The structure of these ETFs, including how they hold the underlying asset and manage operational aspects, sets a precedent. If Ethereum ETFs demonstrate robust compliance and attractive performance, it validates the ETF structure for crypto assets more broadly. This, in turn, can reduce the perceived risk for institutions looking to gain exposure to Bitcoin through similar, regulated channels. Furthermore, the market's positive reception to Ethereum ETFs suggests a strong underlying demand for institutional-grade crypto investment products. This demand is not necessarily limited to one asset. Rather, it indicates a broader appetite for regulated exposure to the digital asset class. By proving the model with Ethereum, the path forward for Bitcoin could become clearer, potentially accelerating its own institutional adoption by leveraging the lessons learned and the infrastructure built. The interplay between regulatory bodies, financial institutions, and the underlying technology is critical. As regulators become more familiar with the mechanics of crypto ETFs and witness their market integration, their approach to Bitcoin ETFs may become more favorable. This could lead to a virtuous cycle where increased clarity fuels more institutional investment, which in turn drives further innovation and adoption. The focus is on how this momentum in the Ethereum ETF space can translate into tangible progress for Bitcoin, breaking down existing barriers and unlocking its full institutional potential. Analysts and investors are closely monitoring whether the momentum generated by Ethereum ETFs will directly translate into increased institutional interest and product development for Bitcoin, potentially setting a new standard for crypto asset integration into traditional finance. But hold on, because the market is showing some surprising shifts. We're about to dive into how Ethereum ETFs are surging, while Bitcoin seems to be losing some of its institutional shine. Ethereum ETFs surge as Bitcoin loses institutional favor. Is the market rotation from Bitcoin to Ethereum already underway? In a significant development that has captured the attention of the financial world, Ethereum ETFs have experienced a remarkable surge in inflows, marking a notable divergence from Bitcoin's recent performance. Data from CoinShares and Farsight Investors reveals that Ethereum ETFs attracted an impressive $625 million in inflows during the final week of August. This inflow trend reverses earlier outflows and signals a robust resurgence in investor appetite for the second-largest cryptocurrency. This stands in stark contrast to Bitcoin ETFs, which endured a challenging period, facing nearly $1.3 billion in outflows between August 19 and August 22, 2025. This dramatic shift suggests a potential rotation of capital within the digital asset market, with investors increasingly favoring Ethereum. James Butterfill, CoinShares head of research, attributed the strong inflows into Ethereum ETFs to a sharp mid-week price recovery. While the week began with $440 million in outflows, the tide turned dramatically on August 21 and 22. During these 2 days, Fidelity's FETH and BlackRock's ETH collectively garnered inflows exceeding $240 million. This surge in investor confidence coincided with a significant price appreciation for Ethereum, which climbed from approximately $4,225 to nearly $4,883 within the same timeframe. This price action not only validates the positive sentiment, but also reinforces the upward momentum of the asset. Further highlighting Ethereum's growing appeal, year-to-date data shows that inflows have accounted for a substantial 26% of total assets under management for Ethereum, significantly higher than Bitcoin's 11%. This metric strongly suggests that Ethereum is increasingly becoming the preferred choice for both institutional and retail investors seeking exposure to the crypto market beyond Bitcoin. The shift in investor sentiment is partly attributed to the Federal Reserve's policy signals. Following Federal Reserve Chair Jerome Powell's remarks at the Jackson Hole Symposium, which were perceived as more dovish than anticipated, a palpable change occurred in market dynamics. This dovish tone led to a partial reversal of earlier outflows, particularly for Ethereum ETFs, as investors recalibrated their positions in light of evolving interest rate policies. Conversely, Bitcoin ETFs continued to grapple with outflows, with BlackRock's IBIT and Fidelity's FBTC experiencing the largest redemptions on August 19. The broader altcoin market also reflected this mixed sentiment. While XRP and Solana saw modest inflows of $25 million and $12 million respectively, Sway and Tonkin experienced outflows. This indicates a broader reallocation of capital across the crypto space, with Ethereum emerging as a primary beneficiary of recent investment flows. This trend could signal a significant rotation in capital, with Ethereum potentially gaining ground on Bitcoin as a preferred institutional asset, especially if this momentum is sustained. However, Bitcoin's dominant market capitalization and its established position in the market mean it remains a formidable force in the overall crypto landscape. This significant inflow into Ethereum ETFs, coupled with outflows from Bitcoin ETFs, indicates a potential paradigm shift in investor preference within the digital asset market. But the impact of this rotation is being felt across the board. We're now turning our attention to Bitcoin's own price action and what it means for traders. Bitcoin nears 7-week low as traders pivot to Ether. Is Bitcoin's dominance starting to wane as Ether gains momentum? Bitcoin, the premier cryptocurrency, has recently dipped to its lowest point in nearly 7 weeks, signaling a notable retreat from its mid-August record highs. The digital asset saw a decline of as much as 0.8%, falling to $108,719 in early Asian trading on Tuesday. This drop also saw it slip below its 100-day moving average, a key technical indicator, according to data compiled by Bloomberg. This price action reflects a broader shift in investor sentiment, with a clear redirection of focus and capital towards Ether, the second-largest cryptocurrency. Ether, in contrast, has been exhibiting increasing strength, having recently hit an all-time high of $4,955 on Sunday. While Ether has also experienced a slight pullback since the weekend, investor confidence remains high, with significant bets being placed on its continued ascent. This divergence is starkly illustrated by the contrasting flows into their respective exchange-traded funds, ETFs. In August alone, U.S. Bitcoin ETFs witnessed net withdrawals exceeding $1 billion. Simultaneously, Ether-linked funds experienced substantial inflows, drawing in approximately $3.3 billion. This data provides the clearest indication, yet of a significant investor rotation favoring Ether over Bitcoin. The current market environment has proven challenging for holders of both major cryptocurrencies. Sean Dawson, head of research at Derive, Zeiss, commented on the recent downturn, stating, "It's been a bloody start to the week for the majors, with over $900 million in liquidations across crypto markets." He further elaborated that the majority of these liquidations, totaling $324 million for ETH and $209 million for BTC, stemmed from long positions that were forced underwater due to a broad-based market correction. This indicates widespread deleveraging and a cautious sentiment prevailing among traders. Derivatives data further underscores this growing caution. Dawson highlighted that the 25 delta skew, a metric used to gauge whether traders are paying more for downside protection, puts, than for upside exposure, calls, has turned negative for both Bitcoin and Ether. This negative skew suggests a stronger demand for put options, indicating that traders are anticipating further price declines and are actively seeking protection against potential downside risks. Consequently, traders are preparing for possible retests of key psychological levels, with expectations of Bitcoin revisiting the $100,000 mark and Ether potentially dropping back towards $4,000. As of 7:24 a.m. London time on Tuesday, Bitcoin was trading at $110,095, while Ether was priced at $4,420. This price differential and the underlying market sentiment reflect a market where Ether is currently capturing the imagination and capital of traders, potentially at Bitcoin's expense. The current market dynamics clearly show a shift in trader preference, with Ether outperforming Bitcoin and attracting significant capital inflows. But the story doesn't end with price action and fund flows. We're now shifting gears to explore a different kind of crypto strategy from a sovereign nation. The UAE's Bitcoin Reserve, a cautionary tale of sovereign crypto strategy. Can a nation's bold crypto bet serve as a lesson for others? The United Arab Emirates, UAE, has been making significant strides in exploring and integrating digital assets into its economic framework. As a nation that has consistently demonstrated a forward-thinking approach to technology and finance, the UAE's foray into cryptocurrencies, particularly Bitcoin, is being closely examined. This exploration isn't just about adopting new technologies. It's about crafting a sovereign strategy that balances innovation with stability and risk management. The UAE's approach to building a Bitcoin reserve, while ambitious, also presents a unique case study, offering valuable insights and potential cautionary tales for other nations contemplating similar paths. At the heart of the UAE's strategy is a desire to diversify its economic base and embrace the future of finance. By holding a reserve of Bitcoin, the nation signals its belief in the long-term potential of digital assets as a store of value and a medium of exchange. This move aligns with the broader global trend of countries exploring central bank digital currencies, CBDCs, and other blockchain-based innovations. However, the volatile nature of Bitcoin and the evolving regulatory landscape present considerable challenges. The decision to allocate sovereign funds to Bitcoin requires a robust understanding of market dynamics, risk assessment, and a clear long-term vision. Unlike traditional reserves held in stable fiat currencies or gold, Bitcoin's price can fluctuate dramatically, posing potential risks to national financial stability if not managed prudently. The UAE's strategy likely involves sophisticated risk management protocols, potentially including hedging strategies and strict allocation limits to mitigate these inherent volatilities. Furthermore, the regulatory environment surrounding cryptocurrencies is still developing globally. The UAE, through entities like the Virtual Assets Regulatory Authority, VARA, in Dubai, has been actively working to establish a clear and comprehensive regulatory framework. This proactive approach is crucial for fostering trust and attracting legitimate investment, both domestically and internationally. However, the interplay between national reserve policies and global regulatory trends is complex. A sovereign nation's decision to hold Bitcoin reserves could influence international perceptions and potentially encourage other nations to follow suit or, conversely, attract regulatory scrutiny. The UAE's experience will undoubtedly provide critical data points on the feasibility and sustainability of such a strategy. The success of this initiative will depend on several factors, including the UAE's ability to navigate the inherent volatility of Bitcoin, its effectiveness in implementing sound risk management practices, and the broader evolution of the global regulatory environment for digital assets. It also raises questions about transparency and accountability in managing national reserves. As the world watches, the UAE's bold move serves as a compelling example of how sovereign nations are engaging with the digital asset revolution, offering lessons in innovation, risk, and strategic foresight. This bold move by the UAE highlights the growing global interest in digital assets and the complex considerations nations face when integrating them into national financial strategies. And that wraps up our deep dives into today's top stories. But before you go, we've got a lightning round recap of all the key takeaways. And that's a wrap on today's essential updates. We saw Ethereum ETF surge as Bitcoin faced outflows, signaling a potential market rotation. Bitcoin itself dipped to a 7-week low amid this shift, with traders pivoting attention to Ether. We also explored the UAE's unique sovereign strategy regarding its Bitcoin reserves, offering a fascinating look at national-level digital asset adoption. Don't miss out on future market-moving news. Hit that like button, subscribe to Bitcoin Bulletin for your daily dose of crypto insights, and ring the notification bell so you're always the first to know. Plus, follow us on all our social channels for real-time updates and join the conversation. We'll see you in the next one.